Hello students, welcome back for the part 7 session of capital gain chapter under income tax subject for final year BCom students. In the previous sessions we have learnt about exemptions under capital gains from 54 to 54 GA. So let us start some illustrations which is related to 14 marks. The first illustration: from the following particulars compute taxable capital gain of Mr. Shankar, that is resident, for assessment year 2019-20. We have assets, that is house property, personal jewelry, listed debentures, personal car, urban agricultural land. Apart from that, we have date of purchase of all the assets, the cost, that is the purchase cost we have, then fair market value as on 1/4/2001, then date of sale when it is sold. You can see all the dates which is sold will be done in 2018-19. Then sales price, that is selling price. Selling expenses is the amount which is done on at the time of sale, that is nothing but realization expenses. In the illustration, the taxpayer or the assessee will be Mr. Shankar, a resident in India, and in the illustration we have 5 different assets. One is house property, personal jewelry, listed debentures, personal car, and urban agricultural land. So let us start with the solution. First we need to make columns, that we have 5 assets. For those 5 assets we need to make 5 columns. I have given the heading as computation of taxable income from capital gain of Mr. Shankar for the assessment year 2019-20. We have 5 assets: house property, personal jewelry, listed debentures, personal car, and urban agricultural land. As I told you in the starting session only, there are some assets are excluded from the capital asset. Those assets will be considered as exempted while calculating capital gain. So now we'll first, always when we are started with these kind of problems which we are having more than one asset, we need to check first whether the particular assets are exempted or not. Exempted assets can be in the form of any movable properties, any movable assets which is used for personal, then it will be exempted, but except gold, jewelry, sculptures, painting, drawings, and agricultural land situated in rural area will be also exempted. If any gold deposit bonds will be also exempted, and any stock which is traded for the purpose used for the business, that will be also exempted. In this illustration we have 5 assets. On that 5 assets, 3 we need to check properly whether it is exempted or not. First one is personal jewelry, then personal car, and then urban agricultural land. So as I told you, any movable property moving from one place to another place, if it is used for personal, then it will be exempted except gold, silver, drawings, paintings. So here first one is personal jewelry. Jewelry can move from one place to another place. It is also used for personal as they have mentioned, but it will come under gold. So that is the reason it will be considered for calculation. Next we have personal car. Car can be moved from one place to another place, so it is used for personal, and it will not come under gold and silver. So this personal car will be exempted from the calculation. Then we have urban agricultural land. As I told you, agricultural land which is located in the rural area will be exempted. As they have mentioned, it is located in urban area, then it will be considered for calculation. They may say that it is within the municipal limits. If it is within the municipal limits, then it will be also considered as urban area. So in this 5 assets, personal car is exempted, so let us enter it. Entire column will be exempted. There we are not going to calculate anything. So let us start by finding out whether other assets will come under long-term capital assets or short-term capital assets by checking their purchase date to sale date. So for the first asset is house property. So let us check when it is purchased and when it is sold. House property will come under category of land and building. So it is purchased on 2007, sold on 2018. You need to check more than 2 years. So it is more than 2 years only. Then it will be considered as long-term capital asset. Then we have personal jewelry. Personal jewelry will come under the category of other assets. Purchased on 1978, sold on 2018. You need to check whether it is more than 3 years or less than 3 years. so it is more than 3 years, it will be also long term capital asset. Next we have listed debentures. Listed debenture will come under the category of financial assets. So you need to check 1 year, which is purchased on 2007, sold on 2019, so it is more than 1 year, it will be also long term capital asset. Lastly, urban agricultural land, so which is purchased on 1985 and which is sold on 2019, so you need to check under land and building 2 years, it is more than 2 years only, so it will be also taken as long term capital asset. After finding out long term capital asset or short term capital asset, we need to complete each category. So we need to complete first house property, then we can go for personal jewelry, then we can go for other assets. So let us start by each asset. So first one is house property. So sale price is 15 lakhs, so let us take it on the gross sale consideration. Then we have realization expenses, it is an expenditure which is made on sales, so we have also that as selling expenses, amount of 20,000. So after deducting that 20,000 from the selling price, so I'll get an amount of rupees 14 lakh 80,000 as net sale consideration. Then we need to calculate the indexed cost of acquisition. For that you need to check whether it is purchased before 2001 or after 1/4/2001. So let us see, it is purchased on 1/12/2007. As you can say, it is purchased after 1/4/2001. Purchase cost we are supposed to take as 75,000. Then we need to divide it by the year, that is 2007 and 8. We have index number of 129. We need to multiply with the sale year, that is 2018, 19 to 80. So as I have calculated in working note, as you can see here, so house property after 1/4/2001, 75,000 divided by 129 into 280, I'll get 1,62,791 as indexed cost of acquisition. So let me enter that in indexed cost of acquisition. After entering that, we need to check what is the improvement which is made on that house property. As you can see in the illustration, the house property doesn't made any improvements, the assessee has not done any improvements, so the cost of indexed cost of improvements will be nil. Then the total will be gross capital gain 13,17,209. Then we need to check the exemption. As they have mentioned one particular information in the adjustment, he purchased a new agricultural land. So we need to check this for each asset because it is not related to one asset. So we need to check for each asset. So as I told you, if they mentioned a new investment which is for particular asset, then we can consider that investment which is made for that particular asset. Here they have mentioned in adjustment, so this new investment which will be related to all assets, but we need to check the condition whether it will satisfy or not. So we have a sale of house property, we have a purchase of agricultural land. We don't think so it will come under the exemptions because 54 related to house property, 54B related to agricultural land. So other than that, we don't have any purchase or sales related to these kind of exemptions. That is the reason for the first asset the exemptions will be nil. Then we'll get a total of net capital gain with the same amount 13,17,209. Then let us go with the second asset, that is personal jewelry. So first always we are going to take the sale amount. So the personal jewelry sales price is 3 lakh. And then we have also selling expenses amount of rupees 4,500. So let us consider first sales price as 3 lakh. Then selling expenses 4,500. We need to deduct that amount. Then we'll get 2,95,500. Next we need to check indexed cost of acquisition as it is long-term capital asset. So purchase is on before 1/4/2001. So when it is before, we need to compare with the market value of original cost. Purchase price is 12,000, market value is 20,000. We need to compare whichever is the highest, we need to take. Index number will be 100 and 280 as it is sold on 2018. Then we need to, as you can see in the adjustment, I have done a working note for that. It is purchased before, so 12,000 or 20,000, which is greater 20,000 divided by 100 into 280, I'll get 56,000. Then we need to check indexed cost of improvement as this asset doesn't have any improvements, it will be also nil. If I deduct that, I'll get an amount of 2,39,500. Then I need to check the exemption. So sale is jewelry and purchase is agricultural land. I can consider that jewelry as any long-term capital asset, and purchase or new investment is agricultural land. So as this conditions will not satisfy in any exemptions, that is the reason it will be also nil. Total will be 2,39,500. Let us go with a third asset, which is listed debentures. It is also long-term capital asset. So listed debentures which is sold for rupees 2 lakh, and we have also selling price, selling expenditure for that, which is 1000. So let us take the first selling amount 2 lakh. Then we have the selling expenses 1000. So after deducting that 1000, we'll get 1,99,000. Then we need to go with the index cost of acquisition. So it is purchased on 1/12/2007, which is after 1/4/2001. Amount of 50,000 we are supposed to take. For bonds and debentures, we are not going to use index, even though if those assets are long-term capital assets. So remember this, for bonds, debentures, there will be no indexation. Only we need to check whether it is purchased before 1/4/2001 or after 1/4/2001. If it is purchased after, what is the original cost is there, that will be taken. If it is purchased before, we need to compare with the market value, whichever is the higher we are supposed to take. But we are not going to use any indexation. So as we are considering this is as after 1/4/2001, we need to take the original cost of purchase, that is 50,000. So let us take that 50,000. So as you can see in the working note, I've already entered that also. No indexation will be applicable. So index cost of acquisition, that is original cost, 50,000 will be the purchase cost. After deducting that 50,000 with the net sale consideration, then improvements also, we don't have any improvements for this listed debentures, that will be also nil. So after deducting 50,000, we'll get 1,49,000 as gross capital gain. You can check the exemption whether it is applicable or not. So as we have sales, listed debentures, purchase agricultural land, it will also not related to any exemptions, that will be nil. So total capital gain will be 1,49,000. So let us go with the next asset, that is urban agricultural land. The sale amount is 8,50,000 and selling expenses is 30,000. So let us take it. After deducting that, we'll get a net sale consideration as 8,20,000. Let us go with the index cost of acquisition. First check whether it is purchased before or after. So it is before 1/4/2001. We need to compare with the market value with the original cost. So we'll get more for 48,000. So we need to divide it by with 100 and we need to multiply with 280. So as you can see, I have done the calculation and I'll get the amount of 1,34,400. And then you need to check whether they have made any improvements for that. It will be also nil. The total will be 6,85,600. So let us check with the exemption. So new agricultural land, it is purchased. Sold is also agricultural land. As I told you, sale is agricultural land, purchase is agricultural land. So now I can apply the exemption which is under section 54B. So time limit is also satisfied within this question. As you can see, the time limit which is purchased in 2019, within 1 year itself they have purchased. So investment is 1 lakh. So I need to compare that 1 lakh with the gross capital gain. So as I made working note for that, 1 lakh or 6,85,600, whichever is the least, will be considered as exemption. So after deducting that, I'll get net capital gain as 5,85,600. Let us start with one more illustration. Mr. Anand sold the following assets during the financial year 2018-19. Residential house, it was purchased by him during 1998-99 for rupees 5,25,000. He has constructed an additional room during 1999 and 2000 for rupees 20,000. And first floor during 2008-9 for rupees 38 lakhs. The fair market value of the house on 1/4/2001 was rupees 25,000. He sold the house on 30th June 2018 for rupees 98 lakh and paid 2% commission. He purchased a new residential house on 18th December 2018 for rupees 35 lakhs. Debenture of E company, it was purchased by him during 2014-15 for rupees 5 lakh and sold on rupees 16th December for rupees 5,75,000. Then we have a personal mobile phone. It was purchased by him on 30th September 2017 for rupees 48,000 and sold on 16th December 2017 for rupees 50,000. And the last asset, personal gold ornaments. It was purchased in 2012-13 for rupees 6,50,000, sold on 30th February 2018 for rupees 65 lakhs. And then we have cost inflation index numbers. Calculate the income from capital gain for the assessment year 2019-20. First, check the assessee name, Mr. Anand. Then check how many capital assets we have. So Mr. Anand is the assessee and we have 4 capital assets: residential house, debentures, personal mobile phone, as well as personal gold ornaments. Then our job is to do in these 4 assets what asset is exempted. As I told you, exempted assets are any movable property which is used for personal except jewelry, gold, agricultural land situated in rural area, gold deposit bonds, and stock in trade. So these are the exempted. In this we have 4 assets. We need to check which asset is exempted first, and then we need to find out what asset will come under long-term capital asset or short-term capital asset. So I have already prepared a column for 4 assets in the name of Mr. Anand as an assessee, and also I have mentioned the working notes. So let us see which asset will be exempted. So as you can see, personal mobile phone and personal gold ornaments, both are used for personal. Both will be considered as movable property. Mobile phone also we can move from one place to another place. Gold also we movable property which is used for personal will be exempted except gold and diamonds and also silver. So here gold will come under that category. That is the reason it will be considered for calculation. But mobile phone is not come under that category, so it will be exempted. Mobile phone which is used for personal, it can move from one place to another place. That is the reason it is exempted. So now our job is to find out for each asset whether it will come under long-term capital asset or short-term capital asset. So first one is residential house property. Check the purchase date, which is purchased on 1999, sold on 2018. So definitely it will be more than 2 years. So as it will come under land and building, so it will be a long-term capital asset. Next, debentures. So debentures, they have not mentioned listed or unlisted. Consider as unlisted only. Purchased on 14-15, so you will get 2 years. It is more than 2 years only. So for 14 to 2018, it will be more than 2 years. Then it will be also considered as long-term capital assets. Then we have personal gold ornaments. So personal gold ornaments purchased on 2012-13, which will come under other assets category. So sold is on 2018. You need to check 3 years. It is also more than 3 years. Then this asset will also come under long-term capital asset. Let us start by solving each asset. So first is a residential house. So let us take the sale value first. So sale is 98 lakhs. So let us consider it. Then we need to take realization expenses. We have an expenditure which is on the sale. They have paid 2% commission. So you need to take 98 lakh into 2%. So we will get an amount of rupees 1,96,000. After deducting that, we will get net sale consideration 96,04,000. Then we need to calculate index cost of acquisition. For that, check whether it is purchased before or after 1/4/2001. So it is purchased 1998. It is before. Take the amount of 5,25,000. Compare with the fair market value. So as you can see here, market value of the house on 1/4/2001 was rupees 25,000. Compare with these two and divided by 100 and multiply with 280. And you can see this calculation I have done in the working note. 5,25,000 or 25,000, whichever is the higher. 5,25,000 divided by 100 into 280. So I'll get 14,70,000. Then I need to check with the improvements. We have 2 improvements on this particular asset. One improvement, that is additional room during 1999-2000 for rupees 20,000. So this is the improvement which is made before 1/4/2001. So if any improvements which is made before 1/4/2001, which will be ignored, you can see in the working note. Then we have one more improvement, first floor during 2008-9 for rupees 3,80,000. So for that, it is also after 1/4/2001, so we can take it. For 2008-9 we have also index number, consider it. So as you can see in the working note, I have done the calculation. For 2008-9 the index number will be 137. So 3,80,000 divided by 137 into 280, you'll get 7,76,642. After deducting those two, you'll get 73,57,358. Then we need to check, is there any exemption. Yes, one investment he has made. He has purchased residential house. Check the condition first. Sale is residential house, purchase is also residential house, so which will come under the section of 54. Time limit is also within 1 year itself they have purchased, so you can easily say, so the conditions of all that will be satisfied, we can give the exemption. So exemption amount is we need to compare. Investment amount is 35 lakhs, or gross capital gain is 73,57,358. So whichever is the least, 35 lakhs we need to take. We'll get the amount after deducting that, 38,57,358. Next we'll go with the next asset, debentures, which is sold for rupees, as you can see, debenture which is sold for rupees 5,75,000, and also we don't have any realization expenses for that, and realization expenses will be nil. Same amount will get. Indexed cost of acquisition, it is purchased after 1/4/2001 with the amount of 5 lakh, but as it is debenture we are not going to apply index. So for debentures and bonds there will be no indexation, even though it is long-term capital asset. 5 lakh will be taken, and there will be no improvement on this debentures, and the amount of gross capital gain will be 75,000. Then exemption we are not having, as this particular asset doesn't have any investments. So in this illustration they have mentioned investments for each particular asset. If we have, we can consider. If we doesn't have, so we are not going to take exemption. Third one will be exempted. Fourth one is personal gold ornaments, which is sold for rupees 65 lakhs, and there is no selling expenses. Then it will be the same for net sale consideration. It is purchased after 1/4/2001 with the amount of 6,50,000. Index number we need to divide it by 200, multiply with 280. In the working note I have entered that, so I'll get an amount of 9,10,000. Then we don't have any improvements for that asset, it will be nil. Amount will be 55,90,000. And then we don't have any new investment on that asset, it will be nil, and we'll get a total net capital gain as 55,90,000. I hope you guys have understood these two illustrations. Please solve this illustration. If you are having any doubts, please mention in the comment section, and thank you for watching.